We are a niche accounting firm that helps nonprofits manage money with mission. We work with about 80 different clients throughout Dane County, handful in Milwaukee, and a few scattered throughout the country. We help with day-to-day accounting, budgeting, annual audits, preparations, and board governance meetings and that sort of thing. So if you're not getting good financials from your accounting team or finance team, let's please talk. We've been doing Breakfast with Benefits for as long as I can remember, honestly, and we do this starting in the fall. So Rob's kicking off our 21-22 Breakfast with Benefits season. The idea is to bring together the nonprofit community and present them with an expert in a subject matter and hopefully take away some talking points, some lessons learned. We ask this to be interactive as much as you feel comfortable. I will certainly be asking Rob questions along the way myself. Full disclosure right out of the gate, I think I should mention I am a fractional owner in Rob's company, eCIO. I feel very fortunate to be part of that group, investor group, because I believe in what they're doing in helping provide investment services at a lower cost to nonprofits. So without further ado, I'll just let Rob roll with this. Thanks for being here, Rob, and take it away.
Great, thank you, Nick and Becca and Tyler for putting this together. It's a pleasure to be part of this and to present to you folks today. As Nick said, we want to keep this interactive. So as you think about questions or items that you'd like to know more about, please jump in. I don't use Teams a lot, so you may need to yell, or if I don't see the your hand go up. And what I'm going to do first is go ahead and share my screen with you. Okay, let's see. Can you all see that my screen okay?
I sure can.
Okay, terrific. Okay, dynamite. So just a little background on myself and the company. I have about 30 years of experience, actually a little over 30 years of experience in the investment industry. I've served a number of different roles from portfolio management, business development, client servicing, to department oversight roles. And over the most recent 10-year period, I was involved in launching an outsourced chief investment officer business. We call it OCIO for a large financial institution. And that business was focused on working with large nonprofit organizations, typically those that had $20 million or more in investable assets. And so our team built that up to a fairly large business. As we built that, we encountered a number of nonprofits, and actually the majority that have substantially less than $20 million. And we wanted to come up with a high quality, low cost investment solution for those organizations. And that's what led to the launch of eCIO. Also, in addition to my role as an investment advisor to nonprofits, I also sit on the board and investment committees for 2 nonprofit organizations. So hopefully I can share experience from both sides of the table as an advisor, as well as a board member and an investment committee member. So just real quick on eCIO, we were founded on the belief that all nonprofits should have access to institutional quality investment advice at a low cost. And part of the reason we launched the firm are some of these stats you see down here. About 90% of the nonprofits out there, fall into that smaller category as far as asset pools and have very limited options for investment advice. They also pay a relatively high fee. So on average, nonprofits with less than $25 million pay about 1.34% annually of their assets. And when we look at the results have been relatively poor. So over almost a 50-year period, when we look at performance, those clients have systematically underperformed their benchmarks. So eCIO is looking to address these three issues. This is a representative list of some of the organizations we work with. A number of these are in the Madison area, so you may be familiar with them, but we work with religious organizations, educational organizations, performing arts organizations, just a wide variety of philanthropic organizations of all sizes. So today's agenda is to cover off the 5 steps to a successful investment program. And these are the areas that I was planning to go into. And again, as I go through this, please feel free to ask questions. I may skip over some of the slides just to make sure we keep this moving along. But we're going to start with talking about creating an oversight group for your investment pool. So that's step number 1. Step number 2, defining the goals and objectives of your investment portfolio. And then step 3, selecting the right asset allocation and investment approach. 4, seeking professional assistance and things you should think about when doing that. And then last, communicating with your board and your donors about the investment program. So those are the 5 steps that I'll go through. So step number 1, oversight group. So this is, of course, an important component of your program. It creates a group of individuals that will be responsible for direct oversight of the program. If it's a new program, they'll be responsible for establishing that program. So establishing and monitoring the investment program is the first responsibility of that oversight group. The second thing is developing investment and operational policies. So making sure you have all your objectives and policies in a document that everyone agrees upon, and that is typically approved also by the board. The oversight committee, of course, will be responsible for assessing investment performance and service from your investment providers. They will hold meetings periodically to assess that investment performance as well as other aspects of the program, and also to document those meetings. And then last, to report and make recommendations to the board. So an oversight group ideally looks something like this in the center. So, maybe 5 to 7 members. We've worked with groups that have anywhere from a couple individuals up to 20. And when you start getting to that upper end, that gets a little more complicated from a logistics standpoint. Typically, board members are a good place to look for your oversight group. And usually the oversight groups are either called a finance committee, in which case they may have responsibility for the investment program as well as other aspects of the finances, or it may just be an investment committee. But board members are a good place to start. Obviously, any board member that has any kind of investment or finance experience would be a great candidate. Typically, there is a staff member, so the executive director, or if you have somebody in the finance role, typically would be part of this oversight group. That's typically a non-voting person. And then last, outside stakeholders with an investment background. So I know sometimes it's hard to find individuals. We're always looking for volunteers, and you may be an organization that has a lot, or that you're, takes a bit to find, and that's why, range of size from, as few as 3, I think 5 to 7 is what we would consider ideal. One of the first things with an oversight group we like to talk about is creating a charter for the group. And the charter is just a written document that lays out the purposes and responsibilities for that oversight group. And it's nice to have this because everyone understands what their responsibilities are, but also importantly, as there's turnover in the committee or organization, it's been memorialized in a document, so a successor can come in and look at it and clearly understand the exact role of the investment committee or oversight committee. So, but broadly, the investment committee should be establishing any of the investment policies. They should oversee any endowed gifts. They may help in the solicitation process of gifts. Typically, they report to the board, and typically they have some level of decision-making authority, which again would be defined.
You want to talk about charity finances? How to set out a proper oversight committee?
I'm sorry, can you repeat that?
Framing policies.
I'm sorry, I didn't quite catch that question.
I think it was unintentional. Rob, let's go on.
Oh, okay, gotcha. Also, we do on our website have samples of committee charters as well as other documents. So, and I'm happy to email those to you if anybody's interested. The charter also typically would describe the composition of the group. So maybe number of members, kind of terms, whether or not they're staggered terms, as well as details about meeting frequency, record keeping, and kind of how decisions are made. So when I think about creating an oversight group, there's really 3 steps as a executive director or leader of the organization to create the group. The first, I think it is helpful to start at least sketching out what that charter might look like. Get something on paper so you know what the goals are, you know, how many people you want to target, how frequently you want to meet. Step 2 then is to identify the candidates. Typically, the president or the treasurer of the board is one of the members of the oversight group. And then to the extent you have the luxury of multiple people with investment backgrounds, you know, look for a variety. We think in terms of kind of 1 to 3 year terms, and then also be thinking about who might be a chairperson for that committee. And then step 3 is to obtain board approval, you know, agree on the role of the committee with the board, what kind of decision-making ability they should have, what kind of interaction they should have with the board, and then ultimate responsibility. And again, end up buttoning all this up in a committee charter. So that's the first step, oversight committee. The second is clearly articulating your investment goals and objectives. And here, the primary goal is to identify the pool of assets, and there might be multiple pools, but the primary goal or purpose of that pool. And the 2 most common we see are reserve funds. And as that name implies, those would be kind of excess funds beyond what you need for your typical operations that are set aside in kind of a rainy day fund for either an emergency situation, unexpected expenses, or could be for planned expenses, capital expenses that you know will be coming down the road. So reserve accounts. The second pool of assets we see a lot of are endowment funds, and so those are pools of assets where a donor or a grant has been made to the organization, and those assets are really designed to be there in perpetuity. And that endowment pool is designed then to throw off earnings, and those earnings are then used to fund either a scholarship or some operation that your organization is involved with. So those are probably the 2 most common types of pools, and so you would have a different goal clearly for each of your different pools of assets. And that's something we help, you know, of course, articulate. One of the key things we want to identify when we do lay out this goal is what is the investment time horizon for each of those pools. This becomes a critical factor in determining how your investment pool should be set up. So determining investment time horizon, Perhaps identifying a return objective. So sometimes we'll work with organizations, and for say an endowed scholarship fund, they will have an objective to generate X dollars from that pool of assets every year to fund that scholarship or scholarships. Identifying any return objectives, thinking about risk, and I'll talk a little more about that, and then thinking about how we should evaluate the results from the program. So those are the key things there. Again, we want to memorialize a lot of that in a policy document. So that's referred to as an investment policy statement, or IPS. We like acronyms, but that's what IPS is, investment policy statement. And in that statement, we want to do a number of different things. They're kind of laid out here, but basically identify the purpose and objectives, articulate who's responsible for what pieces. There might be some language in there about spending, what can be spent out of the portfolio and for what purposes. Information about asset allocation, and I'm going to talk more about that here in a minute. Any kind of guidelines that the committee or the investment managers need to operate within, any of those parameters. Things about rebalancing the portfolio, so as different asset classes are moving, at what point should the portfolio be rebalanced? Implementation, how we're going to evaluate the performance, so identifying some benchmarks, and then also affirming that the document has been reviewed and approved. And typically best practice is that you review the investment policy statement every 12 to 24 months or so, just to make sure that all the investment committee members are fresh with it. So that's what's involved with identifying and articulating the investment objectives and policies. The third step to a successful investment program is the asset allocation process. And asset allocation is just, if you think about it, it's how we divide up your investment portfolio into different asset classes. So how much do we put into stocks? How much do we put into bonds? How much do we put into cash? And this is a really important part of your investment program. If you look at the academic studies that have been done, about 90% of the return for your portfolio is going to be a function of this decision. So how are we mixing the assets? A lot of times organizations and investment committees are really focused, 75% of their time on evaluating and looking to identify, a hot performing fund. And that's an important part, but when you look at actual returns, the bigger part of your effort should really be spent on getting this part right, because that's going to be the big driver for your returns. Time horizon and risk tolerance are going to be key drivers in determining this mix, in particular the allocation to stocks, and I'll kind of illustrate why that is in a minute. And then last, one of the things that needs to be done or thought about is what kind of return are we going to expect from each of these different categories, each of these different assets, and then how do those assets move relative to each other? So for you numbers people, we call that correlation. And ideally you want an asset pool that has low correlation. So when say stocks are not doing so well, hopefully your bonds are holding up and providing a ballast to your overall portfolio. So we look at correlations between these asset classes, and all that information goes into determining the optimal asset mix. And this whole process is called an asset allocation study. So ideally you want to undertake an asset allocation study to then give you the final answer as to how your assets should be mixed. And then of course we want to document all that information so that we have, again, just best practices of setting a trail of what's happened and why it's happened and how we got to these decisions. So on the asset allocation front, one of the big decisions is investing in stocks or risky assets. And you may ask yourself, well, why do we want to deal with stocks? They are volatile, they go up and down, they create difficulties for us sometimes. And the reason is when you look back over history, and this goes back all the way to 1926, each of these lines represent a different asset class. So first of all, this gray area here represents inflation. So it basically shows $1 invested in 1926. By 2018, you needed $14 in essence to have the same purchasing power as $1. So if you did nothing and you had $1 into 1926, into 2018, you lost significantly. You have a 1/14 of the purchasing power. So investments are really important for long pools of assets. The green line here represents treasury bills. You might think about that as like a bank account, kind of a low but kind of guaranteed return. So that $1 grew to $21. The gold represents government bonds. So these are longer term bonds. So that same $1 now grew to $142. So that's getting interesting. So now you've really compounded out your capital. And then the two blue lines represent large and small stocks. And you can see there that you had a huge multiplier investing in stocks. $1 grew to somewhere between 7,000 for large stocks and 32,000 for small stocks. So a multiple of any of these assets, other assets. Now the downside with stocks is what you see along the way here, where you've got these big downs. This was, of course, the Depression back here. But even more recently in our memory, the 08, 09 Great Recession, where you saw a significant downturn. And so the risk of investing in stocks is that, you invested your money here and now you need to pull it out down here and you're locking in that loss. And that's why time horizon becomes really important. If you have a short time horizon, you probably don't want that risk. If you have a long time horizon, you can ride that risk out and odds are you'll be just fine. And that's part of what we illustrate here, the importance of time horizon when investing in stocks. And so again, this goes back to 1926, and each of these bars, the green and red, represent returns for stocks for each of those years, each of those periods. The green are, of course, positive returns. The reds were negative returns. So when we look at 1 year periods, what we see is about a quarter of the time, 27% of the time, you had negative returns. So that says if you have a 1 year time horizon, there's a reasonably good chance you could end up losing. So you probably do not want to invest in stocks if you have a short time horizon like that. Once we look at 5 year returns, so these start looking at 5 year rolling periods. So if you invest and in 1926 and you hold it for 5 years to 1931, that's the first period and so forth. So you still see some negatives here on a 5 year period, back in the very early days. So about when we start looking at 5 year periods, they're about 13% of the observations are negative. So once you start getting out, past 5 years, there's a fairly high probability that you'll be looking at positive returns from stocks. And then last, when you look out over a 15-year period, you start seeing all of those periods are actually in positive territory. So this is a way to think about asset allocation and what's potentially appropriate for your investment pool tied to time horizon. If you have a short time horizon, you probably don't want to be invested in stocks and in risky assets. You want something that's going to be very conservative. It's not going to return much, but you know the funds will be there. As you start going out over longer periods of time, especially when you start thinking about endowment funds and pools of assets that are there in perpetuity, their investment time horizon is, well beyond 15 years, then having a healthy allocation to stocks makes a lot of sense. So time horizon is key. The other thing that we consider and think about when it comes to asset allocation is the risk tolerance and ability to take risk of the group. So again, time horizon is one key part, but also we need to understand kind of the tolerance of the individuals that are involved on the oversight committee. And so one of the things we've created is an online risk assessment survey that we have each of the oversight committee members answer. It's about 15 questions. We then total up those results and present them back to the oversight group so that we can have a good discussion about, what the group is thinking and maybe how close to those thoughts, reality has actually been and how consistent that is with our views. So that it's really designed to get collective input from the oversight group. And this is one part of the asset allocation study that we do. The second part of the asset allocation study, and this is what we present back to your group, is an evaluation taking that input into how we create the most optimal portfolio for you. And by that, all I mean is how do we maximize the return, expected return of your portfolio for the level of risk that you're taking. And that's what this graph looks like here. This is theoretically the most optimal portfolio you can create for a level of risk. And we want to get really close to that line if possible. And then the other things we look at and present to the committee are, how those different assets have performed over different periods. And then importantly, what everyone is mostly concerned about is the downside risk, drawdowns. And so we'll also graph that out showing that asset mix and how it had performed historically. Again, just to give the group some idea of what to expect with their investment program. And then last, we'll make an asset allocation recommendation, and that will actually involve providing you with kind of forward-looking estimated returns. And this is somewhat of an art. The reason we do this is when we look back at returns, they've been very robust, especially when you look at bonds. And going forward, we know that bonds and fixed income are not going to return much. So we need to kind of tap down expected returns in the future. And so we use a forward-looking return approach to kind of set the right expectations with your oversight committee and in turn with the board. So we'll present something like this to you that will show expected long-term returns and kind of range of returns and have a good discussion around that. So that's the asset allocation piece. Let me just pause. I've done a lot of talking. Are there any questions on that material up to now? Okay, hearing none. I'll continue on. So the fourth step is thinking about working with a professional advisor on your investment program, and we've kind of highlighted some of the key aspects of investment programs and kind of a comparison of a self-managed program, which is how a lot of nonprofits sometimes get started, partly because it's difficult to find advisory help when you have a smaller pool of assets, but kind of a self-managed versus using a fiduciary advisor. And the first aspect is that fiduciary responsibility and oversight. So with a self-managed program, of course, the board is ultimately responsible for everything from a fiduciary standpoint, along with the staff. Once you engage a fiduciary advisor, we become a co-fiduciary to the organization for the investment program. So that means we're obligated to put your organization's interest in front of any other interest individually or as advisors. And so we will act in a co-fiduciary responsibility to your organization and to the board, helping to ensure that all those obligations and kind of best practices are adhered to. The second thing is doing that risk assessment. So really identifying the ability of the organization to take risk with the asset pool. And what we see with self-managed programs is it's typically really influenced by the composition of the board. So if you have a board that's more aggressive, you might end up with a more aggressive investment program. If you have a more conservative board, you might end up with a very conservative portfolio. So we want to take away some of those emotions and really apply a more systematic and kind of scientific approach to determining how those assets should be allocated. Having access to institutional quality investments. So, it's touch and go. Typically with a self-managed program, you're relying on some of the same things you do for your own maybe personal wealth management. And those may not be the best things for an organization from a cost perspective or a selection of investment perspective. The investment policies. So here again, we tend to see a lot of inconsistencies. Most organizations that are self-managed do create some kind of a document, but it might not be very thorough as far as covering off all the different kind of key areas that really should be reviewed and documented. And then reporting and reviewing the program. Typically what we see here is custodial statements. Those would be the statements you get from the organization holding the assets, are what are reviewed. And what's lacking there typically is performance reporting along with benchmarks. So clearly being able to see and understand how your investment program has performed relative to predetermined benchmarks. And then last, and maybe most importantly, is creating an enduring program. This gets more difficult to do on a self-managed basis because it's typically highly dependent on an individual or a couple individuals. And if you have turnover there, that may lead to, kind of stops and starts with the investment program. So one of the things a fiduciary advisor can help is to, create that enduring program, make sure there is a repository, a permanent repository of all the key documents. It's not on somebody's hard drive, but it's stored in a place where everyone can have access to. So what are some of the key things you should consider when looking for an investment advisor? I think the first thing is, will the advisor serve as a co-fiduciary? Not all advisors will take a fiduciary role on your program. And so that's, I think, the first question you want to ask. I think there's not a strong reason to work with an advisor who will not be a co-fiduciary with you. So that's question number one. I think it's good to understand what dedication the advisory firm has to nonprofit organizations. There are a fair number of advisory firms, the majority of them, that are focused on private wealth management, and then on the side, they may work with a couple nonprofit organizations. But as you can see from the material I covered earlier, there are a lot of different aspects to really having a buttoned up investment program. And so I think that's a really good question. You want to ask if the advisor has, is completely independent in selecting the investments they're recommending. So you don't want any conflicts there, and you want to understand if there are any potential conflicts. Fees are very important, and I have a chart on the next page where I'll point that out, but you want to understand what the fees are for the investments that are selected. You want to understand how the advisor gets paid. Any other fees that are associated with the account management, and then what kind of reporting is provided, and then who at the advisory firm and how accessible will they be to provide counsel and guidance to you and to the board and oversight committee. So those are some of the key aspects. So fees are really important, and you probably hear people talk a lot about that. But when you look at the numbers in this chart over here on the right, we just took a pool of assets over a 10-year period, and we applied the average fee that nonprofits are paying, which is 1.34%. And so you see this is a $3 million pool over a 10-year period, grows to $4.6 million. That same pool, if you're paying a much smaller advisory fee, 0.54%, grows to just over 5 million, almost $5.1 million. So, you know, over that 10-year period, there's almost there's over a $400,000 difference, and that's money obviously that you folks have good use for in serving and fulfilling the missions of your organization. So fees are really important, and there's actually, you know, there are guidelines that are out there that have been established, you know, and they basically say that, you know, you need to only incur reasonable costs in managing any charitable funds. So you need to be monitoring this. You need to understand what fees you're paying and how they, you know, compare to what might be available out there. And then just a few items on fiduciary duties of the board members in regards to the investment program. There are basically three key fiduciary duties a board member has. And these are articulated in some of the regulations out there also, but they have duty of care. So basically they need to bring to the board and act the way a prudent person would act in their decision making. They have a duty of loyalty. So that means they need to be thinking about the best interests of the organization in front of any other personal interests. And this is where a conflict of interest policy is really helpful. So I'm sure some of you have, maybe a lot of you have conflict of interest policies that your board members sign. That's a best practice for sure. We do have a template available for that if you need to implement that or look at that. And then last, they have a duty of mission to ensure that they're focused on your organization's mission and that they're following all the aspects there. And then keeping your board up to date. So again, board members need to meet their fiduciary responsibilities, and one part of that is making sure that they're reviewing on a periodic basis the results from the investment program. And I know, you know, the same thing is true with your financials, and I know Nick works with organizations to make sure that their board members are meeting it from that perspective. So regularly reviewing and updating the committee documents is a key part. We suggest the investment committee set a schedule so they're meeting prior to the board meeting, so that then the chair of the investment committee can present at that board meeting. Providing access to essential information. From an investment perspective, best practice is to have quarterly investment updates and quarterly investment reviews. To document the rationale for all decisions that are made, and then to fully document all this information. So I'm going to take a minute and just share with you how we do some of that for our clients. I'm going to bring over a new screen here. So as I mentioned earlier, we started working with nonprofit organizations and working with larger ones. And when we thought about how can we better serve the underserved section of the nonprofit area, one of the key things we needed was a way to scale our services to make them available to smaller organizations and really organizations across the country. And so a big part of what we've done is built out a technology platform. So each of our clients have their own portal that looks like this. Your organization's name would be up here. And then all your board members and committee members can be provided with access to this platform. And we use it primarily for the investment side so that we can easily communicate and committee members and board members have access to up-to-date information. So on the investment side, this is what it looks like. We report information, up-to-date information as of the previous close. So this goes through yesterday, September 20th, showing, any of the activity, withdrawals, deposits, investment return, and then closing value as of yesterday. We show the asset allocation. So how is the fund allocated? In this case, 60% is invested in equities, 30% in fixed income. We also have the ability to, it doesn't show here, but to have the portfolio targets and ranges listed here. So you can see how this compares to targets. You can see how the portfolio value compares to what was deposited. So the gold line is what had been deposited, and the green line is kind of where it's at today.
Hey, Rob, I don't know that new screen is showing, or maybe it's just me.
Uh-oh. I'm sorry. Let's see. All right, let me stop share for a second and then restart. Sorry about that, guys. Well, technical difficulty here. All right, let's see. I'm going to go there and then bear with me 1 second. All right, how about that? Still doesn't show, does it?
Nope, nothing's on there right this moment.
Okay. All right.
Other than my face.
Okay, open share. I'm going to try something a little different here. Let me see if this. Okay, there we go.
There it is.
We got it now?
Yep.
Okay, so let me back up here real quick. Sorry about that. So again, what we show is up-to-date information through yesterday's close, so through September 20th. So you can see the market value at the beginning of the third quarter, June 30th, any withdrawals, and you can hover over these to see detail, any deposits, investment return, and then closing market value as of yesterday. And along with that, you can see the asset allocation. So here we have 60% in equities. There is also a table that can be illustrated here with your targets and your ranges for the asset allocation. And then this chart, so the one I was talking about, shows in gold the original deposits and then the market value of the account. And then last, the actual holdings. These are rolled up into broad categories, but you can click on those categories and then you can see the subcategories as well as the individual holdings in there and the composition. So that's available and updated on a daily basis. We also provide our monthly market commentary, and this is on-demand video that we push through to your portal. So on a monthly basis, usually within 2 or 3 days of the close of the month, we'll put out a recap of what happened in the markets, and your committee members can just come in here at their convenience and play it. It's accessible by phone or tablet also. And then we also will put together a quarterly report. This is specific to your organization's portfolio. So we'll go through kind of a 5 to 7 minute update on a quarterly basis of your portfolio and how it performed relative to benchmark. So all of this is pushed out relatively soon after quarter end or month end, depending on the report. And the participants are notified that it's available, and they can click on that notification and takes them into this portal. There are a few other things here that we have. So we have a dashboard, and this can be used, and a number of organizations use this much more broadly for kind of overall board management affairs. There's a calendar for the organization in here where you can schedule events. We have Zoom integrated into this, so when you schedule an event, you can indicate that it's an online video. This will automatically create a Zoom meeting. If you want to record the meeting, this is checked, and then that meeting will get recorded and archived with this meeting date. And you can also, of course, put agendas and minutes and things like that with that meeting date. And so then all of those are available for the committee members. As far as documents, I talked a lot about, creating the right policy documents and then having a repository for them. So this is where we do that. So you can create a foldering system that has all the specific documents, and these can be permissioned to if you have multiple groups. So they can be set up for, this is just the executive committee, or this folder is available to anyone that you've provided access to the portal. Financial statements, this one's locked down, so only investment committee can see what's in that folder. So this is where we store all the documents that you want to have available. So again, as you have turnover in your oversight group, a new member comes in, they now have access to kind of that historical perspective on, what happened in the program and where. And there's a number of other things that are in here. We have secure email, so communication between our organizations can go back and forth, and we don't have to worry about account numbers and using an outside encrypted email service. This is all secure. There's a polling service in here, so you can take virtual votes on items. So this was just, do you approve this revised? You can come in here and vote and make comments and so forth. And then you can create a close date on these polls too. So once you close it, then it's locked down and memorialized at that point. So it's just an easy way to, in this world that we're operating in, to conduct meetings and votes and polls and so forth. So there's a number of other things in here, but this is the key part that we use for communication. So I'm going to stop that there.
So Rob, what's something that our attendees can do to get in touch with you and start a conversation about shifting their portfolio if that was something that they were considering? I see a number of people on the call that I believe have funds currently invested elsewhere, and I'd want them to have an opportunity to at least have a conversation with you about the possibility and lower fees and better performance, just that whole nonprofit mantra that you bring. What would you suggest some first steps?
Yeah, thanks, Nick. I was just trying to find my right screen. Sorry.
Yep, nope, that looks like the right screen.
Okay, so I think I have my screen up. Yeah. Well, a couple things. So this is my contact information. And feel free to reach out. Even if you're not looking to make a change, we're happy to help, provide our opinion or what have you. So my email is right here, just rob@getecio.com. Our website, we have a lot of resources on the website. When you go to the website, if you click on the blog, you'll see a lot of those resources. And then my direct phone number is here. These are some of the pieces that we have out there. Here's our blog. If you go to our main website, you can get to the blog, but there is a lot of information and a lot of resources that we've created. That's one of the things that we've tried to do at a fairly regular cadence is push out relevant pieces to nonprofits regarding their investment program. And so if you want to be on our mailing list, also just drop me a quick email and let me know, and we'd be happy to put you on the mailing list there. There are also a couple other individuals in my organization that work closely with nonprofit organizations. So some of you might know Phil. Actually, the three of us have worked together for the better part of a decade. And Nick, I don't think you've met Courtney yet. Courtney joined us in January of this year. Courtney and I had actually worked together for 10 years at our prior firm. So we're happy to have her on board, and she's also one of the individuals that works closely with nonprofit organizations.
Yeah, Tyler, you've got a question or a comment?
Yeah, just quickly, Rob, I was wondering if you could just kind of share thoughts on socially responsible investing and how that can kind of tie back into missions organizations, and whether or not that's something that you throw a lot of weight behind in eCIO.
Yeah, so socially responsible investing, SRI, or some people refer to it as ESG, which is environmental, social, and governance investing, has gotten a lot of traction in the marketplace. It's one of the investment tracks that we do offer to our organizations. When you go down that route, it does get a little bit tricky. There are different approaches in SRI investing. One approach is seeking out companies with certain characteristics, positive characteristics. And the other approach is kind of an exclusionary approach where you're looking to exclude certain companies, either based on the characteristics of the company or based on the industry that they're in, from your portfolio. And so we have a number of different strategies for SRI investing that can be fairly nuanced. If you have, a specific desire to, say, avoid fossil fuels, or if you just want a more broad socially responsible mandate where you want to tilt your portfolio on average to companies that are ranked much higher in each of those areas, environmental, social, and governance issues. So there are good ways to do that today. Probably 10 to 20 years ago, when socially responsible investing kind of came onto the scene, it was somewhat questionable, I think, as to how prudent it was to employ those strategies. Today, a lot of companies are very aware of kind of the responsibilities to all stakeholders, which goes beyond just their shareholders and maybe their customers, but to include the communities that they're in. And so there's really pretty good information out there now that a lot of companies are sharing about their practices. So it makes it easier and more viable to put together a socially responsible program. So yeah, that's one of the three tracks that a lot of our clients look at.
Okay, thanks.
Yeah, thank
you.
you.
Rob, how about you end us with like a story without naming names, of course, like what is a situation that you've walked into recently where you're like, wow, I'm so glad they came to us. I'm really going to change how their trajectory based on, was it a poorly managed portfolio? Fees were just excessive. You've mentioned a lot of them, but like give us a quick anecdote about, a time that you've really knocked it out of the park.
Yeah, well, So we've taken over a couple self-managed programs, and these were programs where they came upon some money. They didn't really know where to turn, so they opened a mutual fund account utilizing a balanced mutual fund. Not a bad approach, but they were missing kind of all the other aspects of a successful program or of a really buttoned up program. So helping them with developing an investment policy statement, and then doing a proper asset allocation study, and then also repositioning their portfolio into some lower cost options, really made a fairly substantial impact. Getting that asset allocation right, I think, is a needle mover for an organization like that. So there have been a couple situations like that where we've been able to come in and help. The other area that comes to mind is on the cost front. So as I mentioned earlier, the survey data shows average nonprofits paying about 1.3%. Some of them are paying more than that. And so being able to cut those costs substantially, sometimes that's not always really visible on the front end, but when we go and do the analysis and show them what the impact has been, it's very notable.
Yeah, that was perfect. The self-managed one, I hadn't thought about. I'm sure there are nonprofits that are doing. I mean, I can think of a handful myself within my portfolio that, just get by with there might be an investment guy who technically can't give advice on the board, but maybe helps just a little bit. And it'd be great if that was, out, for lack of a better word, outsourced and monitored by somebody more diligently. Well, great. Thanks, Rob, for your time. I hope you all on board on the call found that to be insightful and educational, and definitely give Rob a call if you're in a situation where you might be having self-managed funds or think your costs are too high or just want to talk in general. Rob's a nice guy and can give you some time, I'm sure, to talk through a few things. Tyler, do we have a winner?
We do. It was Charlyn Wood.
Very good. Well, we will make sure Charlyn gets her Amazon gift card electronically for attending. We will do this again in, let's see, September, November. And so look for that invite through our e-blasts. And thanks to everyone for being on the call. I'll see you down the road.
Thank you all, and thank you to Numbers for Nonprofits. We appreciate being able to participate in the webinar this morning, and I wish you all a good day.
Take care.